there, and welcome to the Retirement Wealth Podcast. We're so glad you're joining us today.
Absolutely. It's great to have you here with us.
So let's dive right in. Tax planning strategies before you retire is such an important topic, right?
Definitely. And I think a lot of people overlook it until it's almost too late.
Exactly. The decisions you make now can really impact your financial future.
Well, and this isn't just about saving a few bucks. It's about maximizing what you've worked so hard to build over the years.
Right. So today, we'll cover some key strategies that can help you navigate the tax landscape as you approach retirement.
We'll talk about things like tax-efficient withdrawal strategies, understanding your tax bracket, and even how to use tax-deferred accounts to your advantage.
Plus, we'll touch on some common pitfalls to avoid, because, knowledge is power when it comes to taxes, especially in retirement.
Exactly. And it's all about making informed choices that align with your long-term goals.
So whether you're just starting to think about retirement or you're already on that journey, these strategies will be super helpful.
Let's get into it.
Yeah, let's start with the basics of tax brackets and how they can affect your withdrawals in retirement.
You know, Emily, when we talk about tax planning, it's really about more than just numbers. It's about timing and how it can impact your entire retirement experience.
Absolutely. I mean, so many people think of taxes as just a once-a-year headache, but it's crucial to look at it in the context of their whole retirement timeline, right?
Exactly. And with the current economic landscape, inflation is hitting hard, and many folks are feeling the pinch in their day-to-day lives. This means that planning for taxes now can really help protect your retirement income in the long run.
Yeah, and I've heard from some listeners who are worried about how inflation could eat away at their savings. I mean, if you're planning to retire soon, you really want to make sure your money lasts, right?
Definitely. We've seen how inflation can erode purchasing power. For instance, I had a couple come to me recently. They were planning to retire in just a couple of years, and they were concerned about rising costs. We talked about how tax-efficient strategies could help them maintain their lifestyle without sacrificing their savings.
That's a great point. And then there's the market volatility we've been experiencing. It's like a roller coaster out there. How do taxes factor into that?
Well, during times of market volatility, it's essential to consider how you're withdrawing from your investments. If you're not being tax efficient, you could be selling assets at a loss, or, taking money from the wrong accounts and paying too much in taxes.
Right. I remember reading about a retiree who had to sell off some stocks during a downturn to cover expenses. He didn't realize he'd trigger a hefty capital gains tax because of the way he was withdrawing. That could really set someone back.
Exactly. And then there's the whole Social Security piece. Changes in legislation can impact how much you receive, when you should start taking it, and how it's taxed.
Oh, for sure. I've talked to people who didn't realize that their Social Security benefits could be taxed depending on their other income. It's like a double whammy if you're not careful.
It really is. So being proactive about tax strategies can help mitigate those surprises. And let's not forget about healthcare costs.
Oh, healthcare is a huge concern. With rising medical expenses, you need to factor that into your retirement plan.
Yes, and healthcare costs can vary significantly depending on your income, which can affect how much you pay for Medicare premiums, deductibles, and more. A couple I worked with recently discovered that by managing their withdrawals more strategically, they could reduce their overall healthcare costs.
That's so insightful. It's all connected, isn't it? The decisions you make about your taxes can have ripple effects on your healthcare costs and, ultimately, your retirement lifestyle.
Absolutely. And then there's the emotional side of financial security. You want to feel confident and secure in your retirement, right? If you're constantly worried about taxes or how your investments are performing, it can be really stressful.
It really can. I think about how many people work hard their whole lives only to face uncertainty when they finally retire. It's heart-wrenching.
Exactly. A well-thought-out tax strategy can give you peace of mind. You don't want to be in a position where unexpected tax bills disrupt your retirement plans, or, worse yet, lead you to dip into your principal too early.
And what about legacy planning? I know that's a big concern for many people, wanting to leave something behind for their loved ones.
Definitely. Effective tax planning can play a significant role in how much you pass on to your heirs. For instance, using tax-advantaged accounts properly can ensure that your beneficiaries don't face a hefty tax bill when they inherit your assets.
That's a crucial point. I think a lot of people don't realize that tax implications can affect their legacy more than they might expect.
Right, and with the current trends in estate tax laws, it's essential to stay informed and plan ahead. Doing so can help minimize tax burdens for your heirs, ensuring they receive more of what you intended for them.
So it sounds like it all comes back to having a comprehensive strategy. Like you said, it's not just about taxes, but about your whole retirement plan.
Exactly. And with the current economic environment, it's more important than ever to be proactive. The sooner you start addressing these issues, the better prepared you'll be for whatever surprises come your way.
Absolutely. So, David, what are some core strategies that people can start thinking about right now to enhance their tax efficiency and overall retirement security?
So, Emily, when we talk about tax planning strategies before retirement, one of the first things that comes to mind is understanding your tax-advantaged accounts, right?
Absolutely. I mean, those accounts can make a huge difference in how much you keep of your hard-earned money. Let's break down the differences between a 401k and an IRA.
Sure thing. A 401k is typically offered through your employer, and you can contribute up to $22, $500 a year, or $30,000 if you're over 50, which is nice. It lowers your taxable income for the year you contribute.
Right. And then there's the company match, which is essentially free money. If your employer offers that, it's like getting a bonus just for saving.
Exactly. Don't leave that on the table. Now, an IRA, on the other hand, has a lower contribution limit, $6, $500 a year, or $7, $500 if you're over 50. But it offers some flexibility in terms of investment choices.
And let's not forget about Roth IRAs. They're super popular because you contribute after-tax dollars, and your withdrawals in retirement are tax-free, assuming you follow the rules.
That's a big deal, especially if you think tax rates might go up in the future. Locking in your tax rate now can be a smart move.
Yeah, and speaking of strategies, what about the 4% rule?
The classic 4% rule. It's a guideline for retirement withdrawals, suggesting that you can withdraw 4% of your retirement savings each year without running out of money for about 30 years.
So, if you have $1 million saved, you could withdraw about $40,000 a year. But it's important to remember that it's just a rule of thumb, right?
Absolutely. The 4% rule assumes a balanced portfolio of stocks and bonds, like a 70/30ths or 60/40ths split. But market conditions can change, and personal expenses can vary, so it's wise to adjust based on your situation.
Right. And that's where having a solid asset allocation strategy comes in. It's all about managing risk and return.
Exactly. As you approach retirement, you might want to gradually shift towards more stable investments. Bonds are generally safer, but they also have lower returns compared to stocks.
So if someone is heavily invested in stocks and they're close to retirement, they might want to reconsider, huh?
Yes! A market downturn right before retirement can really hurt your savings. Diversifying your investments can help mitigate that risk.
And real estate is another asset class to consider. I mean, it's not just about stocks and bonds.
That's true. Real estate can provide rental income and potentially appreciate over time. Plus, there are tax advantages, like the mortgage interest deduction. But it requires active management and can be less liquid.
Good point. And then there are annuities, which can provide guaranteed income, right?
Yes, annuities can be a good option for some people. They come in various forms like fixed, variable, and indexed annuities. Just be aware of the fees and terms. Some can be complicated.
And optimizing Social Security benefits is another crucial piece of this puzzle.
Definitely. Deciding when to start taking Social Security can significantly impact your overall retirement income. The longer you wait, up to age 70, the higher your monthly benefit.
Yeah, that could be an extra 8% increase per year for every year you delay past your full retirement age.
Exactly. But it also depends on your health, financial situation, and whether you plan to work part-time in retirement.
So what about withdrawal strategies? Besides the 4% rule?
Well, there's the bucket strategy, which segments your investments into different buckets based on when you'll need to access the funds. For example, you could have a short-term bucket with cash for the first few years, and a long-term bucket invested in growth assets.
That makes sense. It's a way to manage risk while still having access to cash when you need it.
Exactly. And another important aspect is understanding required minimum distributions, or RMDs, which kick in at age 73. You have to start withdrawing a certain amount from your tax-deferred accounts, like your 401k and traditional IRA.
Right, and that can impact your tax situation. If you're not careful, those RMDs can push you into a higher tax bracket.
Yes, which is why planning ahead is crucial. You may want to consider strategies to minimize your RMDs, like converting some of your traditional IRA to a Roth IRA before you reach that age.
That could potentially reduce your taxable income later on, huh?
Exactly. It's all about looking at the bigger picture and finding ways to be proactive.
And let's not forget about tax loss harvesting. That's another technique to consider, especially if you have taxable investment accounts.
Yes, that involves selling investments that are losing value to offset gains elsewhere, thus minimizing your taxes. It's like a little strategy to help you keep more of what you make.
So many layers to this, right?
There really are. The key takeaway is to have a plan and regularly revisit it as your life circumstances change.
And now that we've covered all these strategies, what are some common pitfalls people should avoid?
Well, that's crucial. Let's dive into those next. So, Emily, one common pitfall I see quite often is something called sequence of returns risk. It's a bit of a mouthful, but it's really important for people to understand.
Right, I've heard that term before. What does it actually mean in a retirement context?
Well, basically, it refers to the risk of receiving lower or negative investment returns early in retirement when withdrawals are being made from your portfolio. If the market takes a downturn just as you start drawing from your savings, it can really impact your long-term financial stability, and it can be tough to recover from that.
That makes sense. So what are some examples of how that can play out for retirees?
I had a client, let's call her Margaret. She retired in 2008, right before that huge market crash. She had a solid plan, but when she started withdrawing funds during that downturn, it greatly affected her portfolio. Her investments were down, and she was still taking out money for living expenses. It became a vicious cycle.
Ouch, that sounds stressful. Did she end up needing to change her lifestyle because of that?
Exactly. She had to cut back on her travel plans and even some basic expenses. It really highlighted the importance of having a diversified investment strategy and not relying too heavily on stocks during those early retirement years.
So what could she have done differently?
Well, one strategy is to keep a portion of your portfolio in more stable investments like bonds or cash to draw from during those early years. That way, you're not forced to sell stocks at a loss. It gives your investments time to recover.
That's a great tip. What other common mistakes do you see?
Another big one is ignoring taxes in retirement withdrawals. A lot of people think, I've saved this money, it's mine, but they forget about the tax implications.
Right? Like taking money out of a tax-deferred account, for instance.
Exactly. If you start withdrawing from your traditional IRA without a plan, you could find yourself in a higher tax bracket than expected. I had a couple, the Johnsons, who thought they were in the clear because they were retired. But when they started pulling money out for their travel plans, they didn't account for the tax hit. Their tax bill surprised them, and not in a good way.
Oh no, what did they end up doing?
They had to scale back their travel plans significantly to cover those unexpected taxes. A little planning could have helped them withdraw strategically over the years, keeping their tax bill lower.
So it's really about understanding how those withdrawals affect your tax situation, right?
Exactly. And speaking of unexpected costs, healthcare is another area where people often underestimate their future expenses.
Yes, that's a big one. I've heard healthcare costs can really add up in retirement.
They can. A lot of folks don't realize that Medicare doesn't cover everything. I had a client, let's call him Tom, who thought he was covered, but when he faced a major health issue, his out-of-pocket expenses skyrocketed. He hadn't planned for that, and it really strained his finances.
That must have been tough for him. How can people prepare for those healthcare costs?
Well, it's important to have a comprehensive healthcare strategy. Consider long-term care insurance or setting aside a specific bucket of funds for medical expenses. Don't underestimate those potential costs.
That's really good advice. What about longevity? I've heard that catching people off guard can also be a factor.
Absolutely. Many people underestimate how long they might live, and that can lead to running out of money. I had a woman named Linda who thought she'd retire at 65 and be comfortable for 20 years, but she ended up living to 90.
Wow, that's a significant difference. What happened to her financially?
Well, she had to drastically adjust her lifestyle in her 80s. If she'd planned for a longer retirement, maybe set aside extra funds, she could have enjoyed her later years without that stress.
So it's crucial to plan not just for a few years, but possibly for decades, right?
Exactly, and that brings us to asset allocation. A lot of retirees stick with what they had in the accumulation phase, and they don't adjust their portfolios as they should.
Can you explain what that looks like?
Sure, for instance, many retirees keep a heavy allocation in stocks, thinking they'll keep growing. I had a client named Jim who was 70 and still 80% in equities. When the market dipped, he was really worried about his retirement income.
Did he have to make some changes?
Yes, we worked together to rebalance his portfolio to include more bonds and fixed income, which provided more stability. It's important to adjust your risk tolerance as you near or enter retirement.
That's really insightful. What about Social Security? I've heard some people claim it too early and regret it.
That's another big one. Claiming Social Security benefits too early can lead to reduced monthly payments for the rest of your life. I had a couple who claimed at 62 because they wanted to travel. They didn't realize that it would cost them thousands in benefits over the long term.
That's a tough lesson. What would you suggest instead?
Well, if possible, delaying those benefits can significantly increase your monthly income. It's worth looking at your overall financial picture and determining the best strategy for claiming.
So it really comes down to planning and being aware of these pitfalls.
Absolutely. Spotting these red flags early can make a huge difference in your retirement experience. It's about having a proactive rather than reactive approach.
And if someone realizes they've made one of these mistakes, what can they do?
First, it's never too late to adjust your strategy, reassess your withdrawals, diversify your investments, and keep an eye on your healthcare costs. And, most importantly, don't hesitate to consult with a financial advisor who can guide you based on your unique situation.
That's a great takeaway, David. It sounds like empowering yourself with knowledge and planning ahead can really set folks up for a successful retirement.
Exactly, Emily. Being informed and having a solid plan can help you navigate those potential pitfalls and enjoy your retirement years without the added stress.
Well, that's a lot of valuable information for our listeners. What's next for those looking to take action?
It's all about taking those first steps. Evaluate your current situation, set realistic goals, and reach out for professional advice if needed. You want to make sure you're on the right path to a secure and fulfilling retirement.
Sounds like a solid plan.
So, Emily, when we talk about tax planning strategies, it can feel a bit overwhelming, right? But there are definitely some immediate steps folks can take to get started.
Absolutely, David. It's all about breaking it down into manageable pieces. What would you suggest as a first step for someone looking to dive into tax planning?
Well, I think a great starting point is to review your current tax situation. You can use online tools like the calculators offered by Vanguard, Fidelity, or Schwab. They can help you project taxes based on your anticipated income in retirement.
That's really handy. It's like getting a sneak peek into what your financial future might look like, isn't it?
Exactly. And once you've got a clearer picture, it's time to think about where your income will come from in retirement. The Social Security Administration's website, ssa.gov, is a fantastic resource for understanding your benefits and getting estimates.
That's a great reminder. Knowing how much you can expect from Social Security can really help with planning.
Right? And while we're on the topic of income, it's also important to look at how your retirement accounts will be taxed. Different accounts have different tax implications, so understanding that can shape your withdrawal strategy.
Definitely. So maybe a checklist would be useful here? Like, make a list of all your retirement accounts and note their tax implications?
Yes, that's perfect. And don't forget to consider your other income sources too, like pensions or rental income.
And then, of course, there's the big one. Withdrawals from your retirement accounts.
Exactly. Planning how and when to withdraw from accounts like IRAs or 401ks can save you a lot in taxes. It's a good idea to run some projections on different withdrawal strategies.
That can really make a difference. You know, there are also some great financial planning apps out there that can help track all of this.
Right. Apps like Mint or Personal Capital can give you a holistic view of your finances, which is super useful when planning for retirement.
And speaking of useful resources, are there any books or podcasts you'd recommend for someone who wants to dive deeper into tax strategies?
Oh, absolutely. One book that comes to mind is The Boglehead's Guide to Retirement Planning. It covers a lot of ground on investment strategies and tax implications, and it's very approachable.
I've heard of that one. And there are also podcasts like The Retirement Answer Man that discuss various retirement topics, including tax planning.
Yes, those are great resources. The key is to keep educating yourself and staying informed.
And it doesn't have to be all at once, right? Small, consistent steps can lead to big changes over time.
Exactly. You can start by reviewing your portfolio quarterly. Just set a reminder, and even running those retirement projections doesn't have to be a big task. Just take a little time each quarter to check in.
That's a good point. And let's not forget about tax software, too. Tools like TurboTax can help you better understand your tax situation each year.
Absolutely. It's great for getting a sense of where you stand and what you might need to adjust moving forward.
So if someone feels like they're behind in their planning, it's never too late to improve your strategy, right?
Definitely. Even if you're just a few years away from retirement, you can still make adjustments that could make a difference.
And all these steps can empower listeners to take control of their financial future.
Exactly. With these tools and habits in your pocket, you're really setting yourself up for success.
So those are some practical first steps. Now let's bring this all together.
Well, Emily, as we wrap things up, I think it's important to highlight some key takeaways from our conversation about tax planning strategies before retirement.
Absolutely, David. First off, we discussed how understanding your tax bracket can really help you make informed decisions on withdrawals and income streams.
Right, and then there's the value of tax-deferred accounts like 401ks and IRAs, which can really give you a leg up in terms of tax savings as you approach retirement.
And don't forget the significance of Roth conversions. They can be a powerful tool for managing future tax liabilities, especially if you anticipate being in a higher tax bracket later on.
Yes, and we touched on the importance of taking advantage of tax deductions and credits. Making sure you're utilizing all available options can really make a difference in your overall financial picture.
Lastly, we talked about the need to stay proactive with your tax planning. Regularly reviewing your strategy can help you adapt to any changes in your financial situation or tax laws.
Exactly. It's all about building and protecting your retirement wealth, so you can enjoy those golden years without unnecessary stress.
Well said, David. And to our listeners, remember, retirement planning is a journey. Stay informed, stay proactive, and don't hesitate to reach out for guidance if you need it.
Yes, and if you found today's episode helpful, we'd love for you to like and subscribe. Also, drop a comment with your biggest takeaway or any questions you might have.
And hey, if you know someone who's planning for or already in retirement, sharing this episode could really help them out.
Definitely. And next time, we'll dive into a topic that's super relevant for many: selling your home to fund retirement. It's going to be a great discussion.
I can't wait. So until then, take care of yourselves and keep planning for your bright future.
Goodbye, everyone, and thank you for joining us today.
Bye.